Talk about some of these big movers today, like the cruise stocks, the airlines, gaming, and hotel. They took a big hit already this year thanks to the pandemic. Now we got a UK lockdown putting pressure on those names again. We planned this segment, Stephanie Link. We planned it last week. She's chief investment strategist and portfolio manager at Hightower. You know, if you're disciplined or if you're opportunistic, if you liked coming up with some reopening names on Friday, you got to love them today because they're all 5 to 10% cheaper than they were on Friday. Any change in what you would have told us if this new development hadn't come out of the UK?
Well, it's great to see you, Joe. Thanks for having me on. No, not at all. And in fact, I would love an opportunity to buy all three of the names that I suggested, which is Marriott, Dow, and TJX. I would love to buy them 5, 6, 7, 10% cheaper. I mean, think about Marriott. Marriott is up 116% from the March lows, and it's up 44% in the past month and a half. So, of course, it was vulnerable to any kind of headline. But I think it's very important to step back and say, we just got the fiscal package, which we've been waiting for. So, thankfully, we have that. And I think more is to come on the fiscal side. And then you also have progress on these vaccines. You guys have been talking about it all morning long. So obviously this is not good news today, but I do think in 6 to 12 months from now, we will be reopened. And that's why you want to look at some of these reopened stocks. And all three of these names have really underperformed. I was trying to get you some bargains, actually.
So if Marriott prior to the pandemic was 160, so it goes down a lot, it comes back a lot. You know, some people might think it's already moved quite a bit. If you liked it at 160 before, you're still buying it with a pretty big discount here. Yeah. I mean, it's down 15% on the year still, right? So, and as we reopen, you are going to see a gradual recovery in occupancy rates, rather. And if China is any gauge on occupancy, in the month of September, their occupancy rates were up 67% and up year over year, driven by both business and leisure demand. So they're ahead of us in the recovery. So we watch what happens there. And that is going to be very, very important. And I think the same thing is going to happen here. We just have to wait. In the meantime, they bought Starwood a couple of years ago, and I think there's revenue synergies and cost synergies and scale, most importantly, scale. And so I think they will continue to gain market share. You have easy comparisons, and you have a very strong balance sheet, $2.3 billion in cash and $3 billion in a revolver. So, yeah, I'm willing to be nibbling here today. As I said, it's up a lot since the March low, but I still do like it very much for the long run. Is it the recovering from this pandemic will be more quick for Marriott than for the airlines, even though they're both just pure travel plays?
You know, the airlines are hard, Joe, because they struggle even in bull markets, right, in terms of their balance sheet, cash management, and that sort of thing. So I don't necessarily play in the airline space. I'm just looking for quality and on sale. And Marriott is the best in the business, right? And they just got bigger. So I just feel like that's I don't want to say a safer play, but I do think it's a less volatile play. And that's why I look at that balance sheet and I look at that cash and I feel pretty good about it.
Shepard Smith here. Thanks for watching CNBC on YouTube.